Hey everyone, welcome back to the Weekend Charts. Charlie Bilello here. Another big show for you today. We're going to run through many important charts and themes that are going on in markets and investing. As always, hit that subscribe button for more content just like it. And let's start out with the S&P 500 and talking about all-time highs. Big question everyone's asking. Well, what tends to follow all-time highs? Is this a reason to sell? Is this a reason to be more optimistic? We're going to get into all of that based on the data. But first, let's just take a look now at the bear market that's officially over. The funny thing with bear markets, of course, is you don't know when they're over until you hit a new all-time high. Well, we're finally there. So now we could look back and say October 2022 was the low. It was a 28% bear market, which was kind of right in the middle in terms of historical bear markets. If we look at the median here, 29%. So pretty much right there. If we look at the duration, 9 months, very standard. That's the median in terms of bear markets since 1929. And the number of months it took to get back to a new high. So we hit a high in January 2022, and now we're back at all-time highs. It took 24 months to get there. That seems like a very long time, but historically, once again, right in the middle. So not uncommon by any means. And the time it took to get to new highs from that October 2022 low, we had a 38% rally. It took 15 months, once again, right in the middle. So in terms of all-time highs, we look at this on a calendar year basis as an interesting visual I like to put out. We had a little bit of a drought last year. It was the first year since 2012 with not a single all-time high. We came very close in December, huge rally in November, December, but didn't quite get there. Well, now we're here. 5 straight trading days. We've had the S&P 500 close at an all-time high. We haven't seen that happen since November 2021. And the S&P 500 has crossed above another 100-point milestone here, 4,900 this week for the first time. It took 757 days to get from 4,800 to 4,900. That's the longest amount of time it took to get 100 points in the S&P 500. You have to go all the way back to this huge gap we saw from 2000 to 2013, which took 13 years to cross from 1500 to 1600. So definitely not anything close to that, but it's the longest we've seen. So it's felt like a very long time since we've been at all-time highs. It's been 2 years. And the question is this something for investors to be bullish about? Is this something to be bearish about? A lot of people talking about a double top in the S&P 500. You always have this notion, buy low, sell high. So now the market is high. It's at an all-time high. Should you be selling? And if we look at the data, what we should say, if we're being unbiased, is that there's nothing in particular that stands out in terms of all-time highs with the data, looking at the forward returns. If we see 1 month, 2, 3 months, 6 month, 9 month, 1 year out, pretty much in line with other time periods. So we're looking at new all-time high data here and the other time periods where the market isn't at an all-time high, almost indistinguishable. Average returns over the next year in both cases above 10%. Looking out 3 years, once again, nothing unusual. Market tends to be higher, 5 years even higher, 10 years even higher. Now we go from 10 and 20 years. I've talked about this in the past. We're looking at all-time highs and comparing them to periods of drawdown. You do tend to see slightly higher average returns following drawdowns versus all-time highs. So if you're a long-term investor, 10 years, 20 years out, it's on average better to be buying in a drawdown, but that doesn't mean that an all-time high is a reason to sell by itself. We've certainly seen throughout history all-time highs tend to be followed by all-time highs. And that's a very boring thing to say. A lot of people want to read something more into it, but we know the market tends to go up over time, and the longer the period, the more confidence you can have that it's going to be higher, and that means there's going to be many more all-time highs in the next 20 years to come. Now, ultimately, there's going to be an all-time high. That's the final all-time high before a bear market ensues. We saw that in January 2022. No one knew that that was going to be an all-time high that wasn't going to be surpassed for 2 years. That's going to happen again. It could happen tomorrow. Nobody can tell you when that's going to happen. What we can say is that just looking at the data, that by itself doesn't tell you anything. In fact, what it tells you is likely the market's going to be higher a year from now, no different than any other day. So let's take a look at something that's very unusual in terms of the S&P 500 being at an all-time high, but small caps being still in a bear market. This chart really amazing here. We have data going back to the 1970s for the Russell 2000 index, which represents small caps, and this is the first time in history we've had the S&P 500 with no drawdown, so at an all-time high, and the Russell 2000 in a over 20% drawdown, so still in a technically bear market here. So incredible spread here. So what I did was I went back in history and looked at the other time periods where we saw a big spread, where the S&P 500 was at an all-time high and you had a big drawdown in the Russell 2000 index. And the top three that I found were in April 1999, February 1991, and January 1985. The question being, of course, well, what tends to happen when you have this big gap? Is it a bearish indicator, like many are saying? The average stock is not participating. They're saying there's weak breadth. Is that bearish for the market going forward? Or do you tend to see small caps actually catch up to large caps and move higher over the next year? So let's take a look at the data here. These three previous times: April 1999, February 1991, January 1985. All three of these cases, what we saw over the next year was actually above average returns for not only the S&P 500, but also for the Russell 2000. So April 1999, you had 14% gain in the S&P, 36.5% gain for the Russell 2000. So small caps outperforming, catching up, hitting new highs over the next year period. February 1991, 12% gain for the S&P 500 over the next year. Russell 2000, 35.5% gain. So once again, closing that gap, Russell 2000 joining the S&P 500 at all-time highs. And last example here, January 1985, S&P 500 gained 17%, Russell 2000, 18%. Once again, Russell 2000 outperforming, not as huge as these other two examples, but what we're seeing here is in the past, more likely the scenario seems to be that Russell 2000 catches up and eventually hits an all-time high. And if we look at this historically and we just say, well, what does the data show when small caps are underperforming? So forget about the S&P 500 is at an all-time high and where's the Russell 2000. Just look at the performance spread between the two. And what does that tell you about the future? Well, very interesting here. And I know I've showed this data before, but I want to highlight it again because it goes against pretty much everything that you hear on financial media all the time, which is that when small caps are lagging, it's a very bearish indicator. You should sell out of the market. It turns out that the exact opposite tends to be true. What we see when small caps are underperforming, so the biggest underperformance spreads historically, what you tend to see is big outperformance in both large caps and small caps going forward over the next year. And the real fascinating thing is that the opposite scenario, when small caps are outperforming, so the top 10% periods where the Russell 2000 is outperforming the Russell 1000, what you actually see is underperformance over the following year. So counterintuitive, I know, but here's the rationale for it. What you tend to see after big market declines is investors very slowly start to embrace stocks. And when they're doing so, they want to take initially very little risk. So they're more likely to go into large cap names, household names that you often hear about, but have lower volatility. And so oftentimes in the early stages of a bottoming process, you'll see that large cap index outperform. And then when people are starting to feel better about the markets, you're hearing better news about the economy, with a lag, small caps tend to show a catch up there. So very interesting what we see here. Actually, the alarm bell should be going off historically when you see this massive small cap outperformance. That's actually more of a warning signal than underperformance. So next time you hear that, and you're going to hear it all the time, you heard it all the time in 2023, pretty much the entire year, we saw this massive underperformance of small caps, and everyone was saying, well, that has to be bearish for the market. Well, here's the actual data, and we'll see if this time is the same as those other three examples. But there's nothing based on the data to tell you that this is necessarily bearish. The odds seem to suggest that that gap between small and large is going to be closed, with eventually small caps outperforming and hitting all-time highs once again. So let's talk about the $1 trillion club, and it added a new member this week. That was Meta. Meta coming back to that $1 trillion milestone. It had hit it a few years ago. Enormous drawdown. I think it was below, at its low here, below 250 billion. So more than 4x off of the low, and it crossed above $1 trillion. It's joining Nvidia, Amazon, Google, Microsoft, and Apple. Microsoft and Apple both around that $3 trillion mark. So what an incredible comeback from Meta, and we'll see what happens with their next earnings report. But certainly, the market seems to be betting that turnaround is complete for Meta. And just very interesting here, Nvidia with the huge gains to start off the year here, it's getting closer to Amazon in terms of market cap. Just an incredible run. And so let's talk about the Magnificent Seven here, and the big question I said coming into the year, and the biggest shock would likely be if that Magnificent Seven group of stocks doesn't continue its outperformance. And so far, with the exception of Tesla, which is down 25% on the year, so far we're seeing continued strength in the Magnificent Seven names. And once again, led by Nvidia, up 26% already in 2024. But you're seeing big gains across the board. Meta up over 10%, Google, Microsoft, Amazon, all outpacing the S&P. Apple underperforming a little bit, but once again, Mag 7 outperforming. It's still very early in the year. I think this obviously could change a lot before year end. But what would be the biggest shock to market participants if this were to flip, if we were to see more members here join Tesla on the downside and actually see some underperformance, and see that equal weight and small cap index start to outperform, as we just talked about in the last segment. So if we're looking at the technology sector, and this is the driver, obviously, of that Mag 7 theme, the idea that technology should be outperforming. Technology is the best performing sector in the economy. And what we're seeing here is a ratio of the technology sector to the S&P 500 over time, going back to 1989. And what we've seen here is a few boom and bust cycles, but the big boom cycle was, of course, in the 1990s. You had this relative strength peak in February 2000. The overall market peaked a month later in March 2000. Then you had that massive dot-com crash. Relative strength hits a low in September 2002, but it wasn't right off to the races. I think people forget that there was a period of sideways action that lasted well over a decade, where the relative strength really didn't see a breakout here until 2017. And since then, continues to push higher. We saw that little bit of a pullback there in 2022, but then 2023 off to the races again. And where we are right now, January 2024, is the highest relative strength since March 2000. So in terms of technology, we've seen definitely an enormous boom cycle over the last decade. And this has implications for many areas of the market. If we're talking about growth versus value, this is certainly a big reason for that outperformance. If we're looking at US versus international, again, big reason for US outperformance is this leadership in technology, and also that divide between large caps and small caps. The large cap indices tend to have a higher weighting to tech, and we're seeing this drive that as well. So something to watch. Is it a sign of the top? As some people are saying, nobody knows. This could certainly go higher before it reverses. But certainly this has been a very strong run for a very long time. And it would not be surprising to see technology underperform at some point in the near future. And speaking of which, What tends to be a leading indicator for the technology sector? Well, within that, semiconductors, I've found historically, tend to exhibit some leadership properties. And what we're seeing this year, no surprise, semiconductors outperforming once again NVIDIA, AMD, just skyrocketing this year so far. So this is something to watch. Semiconductors versus the S&P 500. And we'll see. So far this year, again, outperforming, but it seems like sentiment is starting to get to that frothy extreme again in terms of exuberance about these stocks. And so we'll see what happens. Obviously, the big reports are going to be with NVIDIA and AMD's earnings that are going to come out in the next month. So let's talk about the last 10 years in terms of markets. And what I like to say about semiconductors is they've become really the new oil in terms of the commodity that's so important to the functioning of society, the functioning of the global economy. And semiconductors are in everything today, and probably autos being a huge example of the transformation, let's say, from 10, 20 years ago to today, how much more important semiconductors are to that industry. But just look at this divide in terms of performance in the last 10 years. Semiconductor stocks up 824%. NASDAQ 100, which is killed everything else in terms of major indices, up 420%. So you could see how much more semiconductors are up versus the NASDAQ 100. S&P 500 at 214%, not bad at all. Certainly respectable, above the long-term average in terms of returns there. And here you have gold down here, 56%, in the energy sector, 37%. So huge spread last 10 years. Haven't seen this big of a spread if we're looking at semis versus the broad market. You have to go back to that 2000 type of area. It's not as extreme as it was back then, but that would really be the only comparable time period if we're talking about technology outperformance and semiconductor outperformance. So keep your expectations in check. Unlikely we're going to see in the next 10 years anything close to this in terms of performance from semiconductors or technology in general. So let's talk about Tesla. Reported earnings this week. And really, what I like to say about Tesla is it's a textbook example of Mr. Market, of sentiment, and how investor sentiment really drives everything in the short run in terms of performance. And as we know, in the long run, the market's a weighing machine. Fundamentals tend to matter much more. But from year to year, if we're looking at Tesla, I like to look at returns versus revenue growth. So returns being a reflection of Mr. Market. When sentiment is really strong, those returns can greatly exceed revenue growth. When sentiment's really negative, those returns will be well below revenue growth. I think two best examples of that would be, number one, 2020, as we've talked about many times. You had Tesla running up 8x that year, and their revenues only went up 28%. That drove Tesla's valuations to really very high extremes. In 2022, we saw kind of the opposite. Revenue growth continued to move higher, but the stock was hit 65%. Last year, we flipped back. People became optimistic again. 102% gain for Tesla, 19% gain for revenue growth. But let's talk about the recent quarter. What we're seeing here, 3.5% increase in terms of year-over-year growth. So definitely a slowdown for Tesla. The market did not like that one bit. Stock sold off over 10% after that earnings report. And the big problem Tesla's having is that margins are compressing. And we've talked about the price declines, how helpful they've been for the consumer in terms of Tesla. Price of a Tesla car is down 30-40% from where it was just a year and a half ago. That's great news for a consumer. But in terms of the bottom line, that's definitely, they have been hitting Tesla. And we could see that here looking at the gross margins, 17.6% in Q4 2023, and a year before, 23.8%. So huge margin compression, and big part of that is simply they lowered the price on vehicles, and they did that to try to keep demand up. And what their stated goal was, as Musk has talked about, is to try to keep increasing sales and put more Teslas on the road. during this period of very difficult affordability for the consumer. So we've talked about how interest rates are such a huge component for car purchases. Over 80% of people finance the cost of a new car. And with interest rates going from 4% in terms of the average financing rate for cars to over 8%, well, that was a huge, huge shock in terms of what the average consumer could afford. Tesla chose to respond to that by cutting the price of their vehicles very aggressively. And that's definitely hit the bottom line here if we're looking at adjusted EBITDA down 27% year over year. So is this a long-term phenomenon? Are they going to continue to cut prices the way they are? I think that's doubtful. We're probably getting closer to the bottom in terms of these price cuts. But Tesla's making, it seems, a long-term calculated bet here to say we have to continue to push forward, and having more cars, more Teslas on the road, more cars in the ecosystem. Eventually, that's going to benefit them, whether it's selling services or software surrounding that. These are long-term bets that we can't determine today, but that seems to be the strategy. The big question, though, with Tesla for me and for investors is always surrounding valuation and whether it should be valued like a car company, a tech company, or somewhere in between. And if we go back to early 2021, what I was writing about and talking about at that time was it was most definitely being valued like a tech company that was going to have a decade or more of just extremely high growth rates. And what I said at the time was that even if that happens, even if you have 20, 30% compounding growth over the next decade, well, if those expectations shift, if people aren't as bullish at that point as they were in January and February 2021, where you're going to have multiple compression, and that will be challenging for the stock. And if growth rates start to come down, and as we've seen, they've definitely come down. If we're looking at now 3.5%, big difference from where we were in early 2021 when it's trading at 30 times sales, well, then you're going to get a multiple compression. And that's exactly what we've seen here. So 30 times sales down to 6.7 times sales. And for an auto manufacturer, that's still very high. If you're looking at Ford and GM, they trade at like 0.3 times sales. I think Toyota trades at 0.9 times sales, so a little less than one. And certainly Tesla is expected to have higher growth rates than those companies. So some higher multiple is definitely warranted, but the question is how much. And if we look back at Tesla's history, we've seen it trade in the past. If we're looking at 2019, trading at below 2 times sales. So it's not impossible to say that it could go that low again. Nobody knows. Certainly, it could reverse course here. A lot's going to be dependent on what that growth trajectory is. But what they're forecasting so far for 2024 is that growth is going to remain challenging. And if we look at the last few years, and this is really since that peak in valuation, what Tesla's done versus the broad market. Here's really that illustration in real time, why it's so difficult for a company to grow into a valuation multiple that high. We're seeing Tesla stock 37% lower over the last 3 years, while the S&P 500 is kind of the inverse here. It's up 33% over the last 3 years. So as always, Tesla, fascinating company, one of the best performing stocks in the market over the last 10 years, certainly since its IPO. But the challenge, as always, for any stock when sentiment becomes this high, very difficult for investors to have a strong rate of return following that. And Mr. Market really determines everything in the short run. If investors get pessimistic here, this multiple is going to come down. If they get optimistic, it might go up again. But coming back to that big question, where should Tesla trade, let's say, in the long run in terms of this valuation multiple? Is it going to be treated more like a car manufacturer or more like a technology or software player? We don't know that. We'll have to just wait and see. But it seems to be right now in a position where you can make a case either way, and that's going to make for definitely an interesting year for Tesla. So let's talk about Netflix and the comeback here. A lot of people counted Netflix out in the 2022 bear market. It was hit extremely hard. Like Tesla, growth rate was coming down. Unlike Tesla, it's been able to reverse course here. Revenue growth now up 12.5% over the last year. That's the highest growth rate since Q4 2021. It hit a new high in terms of revenue, 8.8 billion. Paid subscribers came in well above estimates. This was the huge one. A lot of people were debating when they cracked down on password sharing. Well, what impact is that going to have on the revenues? Are people going to simply abandon Netflix? Is this going to be a difficult time? Turns out more people said, well, we're going to subscribe to Netflix. We don't want to miss out on this content. They introduced that ad tier as well, which seems to be doing well. But paid subscribers for the year up 13%, 260 million, hit a new high once again there. And after a year of kind of stagnation in 2022, that's a big upside surprise, and that's a big reason why the stock is doing so well over the past year. And look at revenues here. Definitely not the growth that we saw in the early years, but just continues to push higher, around 34 billion in revenues in 2023. And look at where we were just a decade ago in 2013, 4.4 billion revenues. So tremendous growth over the last decade for Netflix. Is this going to continue over the next decade? Almost certainly not. This type of revenue growth for a company now this size, highly unlikely. So what we saw here, looks showing you trailing 12-month revenues over the last decade up 630%. The stock has actually gone up over 1,000%, so 11x increase. So that means there's some multiple expansion in terms of price to sales. Highly unlikely we're going to see this type of growth for Netflix over the next decade. And you could say that for pretty much any of the Magnificent Seven companies. What they've done over the last decade is unlikely to be repeated over the next decade. Just the numbers are so large today, it just becomes much more difficult to have this type of growth. I mean, to go 8x in terms of revenues over the next decade, that would put Netflix, you're talking about 200 billion in revenues in 2033. Very unlikely. I think it's going to grow that much. Certainly could continue to have growth that outpaces the broad market, but this type of gap, don't expect that to continue. So let's talk about banks here. And the big banks reported earnings, revenues, their net interest income, and it was kind of a mixed bag in terms of the banks. But J.P. Morgan Chase definitely the standout in terms of revenue growth, 12% increase year over year, leading all the big banks, and net interest income, 34% increase for J.P. Morgan Chase. And for the full year, JP Morgan had almost 50 billion in profits, almost 50 billion in net income. That is a new record for any bank. We've never seen 50 billion in profits for any bank historically. So definitely JP Morgan is the king. And just to kind of illustrate here who the winner was from all of that banking turmoil, which a lot of people have forgotten about last March, well, it was definitely JP Morgan Chase, up 28% in terms of stock price over the last year. You got the regional bank ETF down 10%. So JP Morgan Chase definitely benefiting from its size, picked up First Republic for almost nothing, windfall profits there. And this seems to be a good environment for the company, and just shows you that too big to be fail concept has only gotten bigger and more concerning, because JP Morgan continues to get bigger and bigger here. And definitely, if there's anything that's too big to fail now, it's definitely JP Morgan Chase. So let's talk about home builders. We got some new data on new home sales adapting to lower affordability. That's would be kind of the takeaway here, because if we look at the median price of a new home that's sold in the US, it's actually down close to 17% off of its peak. And that's the biggest gap that we've seen in terms of a price reduction since the last housing bubble. And back then we saw as much of as a 22% decline off of the peak before new home prices bottomed. a little bit of a different situation today in that this isn't simply, we are seeing price cuts. We are seeing incentives from home builders to try to help with that affordability problem that we've talked about, which is pretty much we have the lowest affordability in history in 2023 for the housing market. So home builders are mindful of this. They want to sell their homes. They have to cut prices. They have to provide incentives. But what they also did in 2023, as we've talked about, is build smaller homes. So the number of 3-bedroom homes versus 4 bedrooms really increased a lot in 2023. So we saw the square footage go down, and so it's cheaper to build those homes, and they're more affordable to more people because they're at lower price points. So it's not so much that they're building the same home for a 17% lower price. It's that mix of homes is different today where that square footage is lower. So they're adapting to conditions. As long as affordability remains low, they're going to build more smaller homes where there's more demand from people that can afford them. And here's a chart kind of illustrating that, looking here in the last year in terms of the median square footage in terms of new single family homes going down, lowest we've seen in over a decade. So be interesting to see how much this can continue. During the pandemic, we saw an increase in terms of demand for bigger homes because more people are working from their homes, and they want an office and they want more space because they're spending more times in their home. But really, this affordability equation has erased that increase and then some. And this isn't a long-term solution in terms of solving the affordability crisis, but it's something that home builders need to do if they want to sell as many homes as they're projected to sell. And as we talked about, enormous deficit in the number of homes. We're in the millions in terms of we need at least a few more million homes, single family homes in the US, in order for the supply demand imbalance to get more in line with one another. So hopefully we see a huge boom in home building this year, and we see an increase in supply. That would be the best thing that could happen for the housing market. So let's talk about the US economic expansion. And the big story from 2023 was that the expansion continued. And now we have final data on that. We got fourth quarter GDP. So the recession that everyone was predicting going into 2023 did not materialize. So we got 3.3% GDP in the fourth quarter. So that's the fourth quarter number annualized. The expectation was 2%. So once again, second quarter in a row, we're seeing a big beat versus expectations. And what we're seeing on a year-over-year basis, which is the way I like to look at it, not just look at the single quarter, but what is real economic growth doing on a year-over-year basis, 3.1%. That was the highest growth rate we've seen since Q1 2022. So definitely an upswing. And if we look at this economic expansion, 44 months now, it doesn't seem like 44 months have passed, but it has since April 2020. So we get a few more months, and we're looking already at 4 years in terms of this expansion. And the unusual thing about this expansion so far as compared to the last few is we're actually seeing the real GDP number be higher. And the reason for that is just a function of what we were coming out of, the big crash in terms of real GDP in that 2020 recession. And we've seen above average growth coming out of it. So what's the expectation if we're looking at leading indicators? And this we kind of point to and kind of laugh at every single month, asking the question, is this indicator broken? It certainly seems to be different than the past few economic cycles in that we've never seen it be this negative for this long without a recession ensue. And so we have the leading economic index moving down once again in their latest reading. That's 21 months in a row now. That is the longest down streak since 2007, 2008. And the conference board who puts out this index, what they continue to do is push back their expectations for a recession. So they haven't called it yet. They haven't said this index is no longer valid. They just keep simply pushing it back. So originally they were calling for a recession in the first quarter of 2023. Then they pushed that back to the second quarter, the third quarter, the fourth quarter, then the first quarter of this year. And now they're saying GDP growth is going to turn negative in Q2 and Q3 of 2024. So we'll see if they adjust that again. Likely, obviously, if there's strong coincident data at that point, they're going to have to push it back. But the big question is, well, why are the inputs to this no longer working? Was it something coming out of COVID that kind of skewed things? Could be any number of things, or it could be simply there's a longer lag this time around than in the past. And on that point, let's come back to the yield curve here, which I've talked about. This would be very normal, let's say, if we saw a recession later this year in terms of the lag from a yield curve, inverted yield curve, and the yield curve looking at 10s minus 3 month, first inverted in October 2022. And now we're 457 days into it. And look back in history, there's only one other time period that was longer, 470 days from 1965 to 1967. And in 2 weeks, it's likely that this is still going to be inverted. We're likely to surpass that record. Now, the interesting thing about this record here is there wasn't a recession back 65 to 67. So the yield curve, that was really the last time it was wrong in terms of predicting a recession, was back then where you had an inversion and no subsequent recession. Is it going to be the same this time around? We'll see. But every inversion after this 65 to 67 period was followed by a recession. And with the Fed now not expected to cut rates until May, perhaps, this is likely to stay inverted at least for a few more months. So we'll talk about this again in a few weeks, but likely to be the longest inverted yield curve that we've seen in history. But again, in terms of predictive properties, just looking at the yield curve, the average time from first inversion to a recession beginning is around 24 months. So 24 months from that October 22 inversion would bring you to October of this year. So this indicator by itself, you can't say yet that it's broken in terms of being a leading indicator, but we do have to be mindful that there have been times in the past where we've had an inversion and no recession has followed. So is that possible again? Certainly possible. Let's talk about China. We talked a lot about this last week, but there was some new news where China seems to be now saying perhaps enough is enough, and maybe markets have gone down too much. They have to step in and start doing something. So it wasn't necessarily surprising. You hear China do this from time to time, but what set this off was probably this chart here that I sent out a few days ago in terms of looking at the S&P 500 at an all-time high and MSCI China ETF over 60% below its all-time high. So what a gap here. We haven't seen a gap this large in history in terms of US versus China. So what happened shortly after I tweeted out this chart? Well, we had news that China, and this is just speculation at this point, it hasn't been confirmed. I don't know how this gets out, or this type of specific thing, but they're saying that China's considering spending up to $282 billion to support the stock market. And I guess that means starting to buy companies literally to push up their prices. And that's not a small number. It's around 8% of the market cap of mainland China stock markets, according to Morgan Stanley. So if they were to do that, it would seem to have an impact. I think what would help even more, as I've talked about, is to stop with their regulatory policies that are hurting the markets, stop with the lack of freedom, stop with the saying that these companies are making too much money and interfering and all the rest of it. And I think that would overnight help the Chinese stock market very quickly in terms of improving investor confidence. And a final point there would be simply to make sure that the data that we're getting out of China is actually accurate. So allowing third parties to come in and do audits of these companies to ensure that what we're seeing is the actual data and the actual numbers. So any number of things, when you have sentiment this low, this sentiment, this negative, any number of things could push up a stock market. We did see a little bit of a bounce so far following this news. We also had China announcing, central bank announcing that they cut their reserve ratio again. So helping the banking system there. As you can see here, they've been doing these cuts for quite some time. So this is not anything in particular that's new. And if you look at China's central bank rate, I think people are expecting we're going to see more cuts there as well, because China is reporting negative inflation, price inflation. Whether you believe that or not, that's what they're reporting. So I think it wouldn't be unreasonable to think they're going to cut interest rates again. So any number of things, when you have sentiment this low, could boost the stock market. And when you have valuations where they are today, looking at the Hang Seng, you have a price to earnings ratio of roughly 8 times. So sentiment is extremely low. It's wanting that positive catalyst. We'll see if it comes. When it comes to China, there's no way to handicap whether these things are going to help or hurt in the long run. What's going to help is an increase of economic freedoms, of personal freedoms. And that's really, in the long run, the only thing I think that will improve investor confidence to a level where it's sustainable. So certainly short-term rallies are possible when sentiment is this bad. Should not be unexpected whatsoever. We'll see if they actually start buying these stocks to prop them up. And we'll see if investors think that that's going to be a solution, or it's just a short-term push higher. So let's talk about the money supply reversal. This is one of the biggest factors, in my view, that led to higher inflation on the way up, was this spike in money supply. And there's that famous saying, inflation is always and everywhere a monetary phenomenon. Well, we saw that once again in this cycle. We had that huge 40% expansion in the money supply in just 2 years, in 2020 and 2021. Thankfully, the Fed got the message, and money supply has pretty much flatlined over the last 2 years. And what we see now, 2022 down for the first time, with data going back to 1959, down 1%, and then 2023 another down year, down 2%. So have we erased 2020, 2021? No, not by any means, but this is good news in terms of inflation, that we're not printing money. We're kind of holding the line here. And if what I would say here is the natural tendency, unfortunately, is for money supply to go up. So it's usually a question, not whether it's going to increase, not whether we're going to print more money, but how much. And so if we held the line once again in 2024, and let's say it was flat in 2024, then if you look at this cumulative period from 2020, it's not so bad. It's looking at roughly 6 or 7% increase per year, which is kind of what we did the 10 years before 2020. So let's see if we can get through 2024 without printing money again. But if we can hold the line here, that has me more optimistic that inflation will continue to trend lower and actually stay lower. So on that point, let's end as we always do with a positive sign, a positive story, and that's that cooling inflation trend seems to be continuing here. We got PCE data out today, 2.6% year over year. That's the lowest we've seen since February 2021. If you remember, we peaked all the way at 7% in June 2022. So very good sign there that it's at 2.6%. And if we look at core PCE, which is the Fed's preferred measure of inflation, that's at its lowest level since March 2021, 2.9%. And importantly here, the spread between the two, so the Fed funds rate 525, core PCE at 293, that spread, 2.3% spread, highest spread we've seen since September 2007. So most restrictive monetary policy we've seen since then. And as I said last week, to me, this is a positive. To me, the Fed should continue restrictive policies until prices come back down to a more normal level, until they come back down to that 2% trend starting at 2020. And there's still a 10% gap to go. So I don't think the Fed should be in any rush to cut interest rates. And now it seems the market is more in line with that thinking and shifting to May instead of March in terms of the first rate hike, first rate cut in this cycle. And we'll see, maybe they'll push it back again. We do have the Fed meeting next week. So they're going to likely, if they're going to cut rates in March, I think they're going to make it very clear at the meeting next week that that's what they're going to do. And if they're looking to cut rates in May or later, I think they'll also make it clear at that point that it's coming at some point this year, just not in March. So big meeting next week. I'll have that on next week's weekend charts. But good news is that core PCE 2.9%. We still have wage growth running above 4%, and that spread is leading to increased optimism, as it should. Consumers are behaving as if this is good news, as they should, because there's more money in your pocket. Your wages are going up more than prices. That it increases your ability to spend. It's a reversal of what we saw in 2022, and why consumers were so negative at that point when consumer confidence hit a record low was because wages weren't keeping up with inflation. We saw the biggest spike in consumer confidence that we've seen since December 2005. And I would expect, with the stock market back at all-time highs, with news that the economy is doing okay in terms of real GDP, with the understanding that U.S. unemployment is still very low, below 4%, I would suspect that we would see this index continue to move up. Is that good news for the stock market? Not necessarily if it gets to an extreme. So as we've talked about, the low levels of consumer confidence tend to be very good for the stock market going forward. We saw that once again this time around, where it bottomed here in 2022, not far off from the stock market bottom. And what we tend to see, very high levels of consumer confidence tends to be associated with below average stock market returns. You could see back in 2000, investors or consumers very confident in what we saw over the next decade, below average returns for the stock market. So I'm expecting the consumer, as long as their wages to outpace inflation, to be positive, more positive in terms of their spending. And if we look at that Fed meeting next week, I'm going to put out my tweet, as I always do, tomorrow's news today, a day before the meeting. But here we have it here. The Fed funds expectations for the meeting is that there will be no change, 97% chance. And the market has been right 100% of the time in terms of predicting what the Fed will do heading into a meeting. And so if this remains next week, there's almost no chance the Fed's going to do anything. It's all about the March meeting or the May meeting. But in my view, we'd be better off if the Fed stays higher for longer. So with that, we'll end it there. Thanks everyone for joining with me this week. Have a great weekend, and I'll see you next time on the Weekend Charts.